Hi, Darius Dales here, Senior Analyst on the Hedgeye Macro team, here to bring you a Macro Minute. Keith and I have been getting pinged all day from institutional subscribers on the desk about this big melt-up in the U.S. dollar, which actually came on the heels of some fairly dovish CPI data today. So we're going to walk through a few charts and explain this move in the dollar in the context of our macro themes and what you should do with it. So if you look at this first chart, you see CPI slowed to negative 10 basis points year over year. It's now decelerating on a sequential and trending basis, and that negative 10 basis points is the first year-over-year rate of change, of decline rather, since October 2009. So that is new and noteworthy. So why is the dollar up on this? Well, if you continue to follow the bouncing ball, if you look at this next chart, we show core CPI. It actually stabilized in January at 1.6% year over year. And that may have implications for the Fed's preferred inflation metric, which is the next chart, which is core PCE. So we get that data point Monday at 8:30 a.m. We'll see if it follows the nascent trend of stabilization in the core CPI. And if that's the case, then the Fed will be able to continue to say this move down in inflation readings is transient. This move in lower oil and energy prices is transient. It'll have a transient impact on inflation. And we're going to continue to set expectations that we're going to tighten monetary policy. So if you look at how we model CPI, which is just regressing it versus the year-over-year rate of change in commodities, and then layering on what we think is an appropriate measure for the comps or the elasticity of the series, what you're seeing is that inflation should bottom somewhere around the middle of the year, roughly around June in that month. So if that is the case, then the Fed will say in July or August be able to say, hey, inflation is transient, it's starting to reaccelerate again, we're on pace to hike interest rates. So that's one explanation for why the dollar is up about 1.5% versus the euro today. If you look at the Fed funds rate curve, which we're showing in these following two charts, the June maturity and the December maturity, they hardly budge today. So you got the dollar signaling hawkish Fed, but if you look at the actual Fed funds rate futures curve, that's not saying that so much. And that tells us one of the reasons we think the dollar is up so much versus the euro today is because of deflation. And actually, if you look at the impact that deflation has on our real interest rates, what you're seeing is those rates are as high as they've been in 5 and 6 years respectively. So that's driving demand for dollars. That's driving sort of cross-border demand for dollars as U.S. interest rate spreads starting to widen versus, say, German bonds or Japanese bond yields or any other sort of negatively yielding long-term treasury bond in these foreign countries. And so, again, that's why we think the dollar is up so much here. We think the dollar move has legs over the intermediate to long term, but we wouldn't necessarily chase it today. In fact, the euro is at its immediate term trade support at $1.12. We'd definitely be covering some euro here and waiting to reshort that higher. So, again, this is Darius Dale. Follow me on Twitter, HedgeyeDDale, with the Hedgeye Macro Minute.